य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Good evening, all the participants. Most respected chairman of the region, CA Ketan Saiya sir, vice chairman of the WRC, CA Piyush Chandak sir, learned faculty and advocate, CA Abhay Desai sir, and coordinator of the day, CA Labdisha, and all the participants. This is indeed a proud and pleasure to have such a litigation series organized under the WRC and the leadership of our dynamic and always motivating chairman CA Ketan Saiya sir. Sir, we are really thankful to you to organize such a great series and meaningful series for the members of the region. With these words, I welcome you all and I request CA Piyush Chandak ji to say a few words. Thank you.
Thank you, Bishan Bhai. Good evening, all the participants. Am I audible, Bishan Bhai?
Yes, sir.
Okay, thank you. Thank you. Good evening, all the participants. First of all, I take this opportunity to congratulate CA Ketan Sayaji, the chairman WRC, and CA Bishan Shah, the chairman of the committee, to organize such a wonderful program on GST litigation series. This is not just a single program, but a series wherein thoughtfully they both have curated the program for the maximum benefit of the participants. And my dear friends, keeping this program online was with the motto of WRC that the program should reach to all the members at every nooks and corners of the region and even across the region, across the country as well. So ultimately, no doubt that taxation practice is a challenge nowadays. At the same time, when a chartered accountant is practicing and doing the compliances, he has to be mastering the litigations as well. He should know every action of his own while filing the returns of the assessees, what final destination it has to like get, and how it will be taken by the department in case of very tricky situations. And in these cases, definitely this kind of a series is going to help all the chartered accountants to take the proper decisions at the time of compliances, and this will differentiate a practicing chartered accountant with the other practitioners in the field. With this, I again congratulate the committee and the chairman and hand over to the Bishan Bhai. Thank you very much for the opportunity.
Thank you very much, Piyush Bhai, for your kind words. And I now request our worthy chairman of the region, CA Ketan Saiya sir, to guide all of us. Thank you so much.
Thank you so much, Bishan Bhai, the learned speaker for the evening, Abhay Bhai Desai, the Vice Chairman of Western India Regional Council, Piyush Bhai, our today's coordinator, Labdi, and the person who is so humble and the person who has actually designed this series along with the Vice Chairman of the GST Committee, Rajesh Agarwal ji, Bishan Shah from Ahmedabad, the past Chairman of Ahmedabad branch. I think, one such dedicated person whose work in council is very clearly seen, be it, various programs of GST or the publications for GST. I think one dedicated person, Bishan Bhai, thank you so much for all work which you do for the region. Coming to today's session, I think very interesting session Abhay Bhai is taking, and it is heading towards, we all are aware of the problems of bogus billing. And second part is input credit. See, output credit is in my hand. I may raise invoice and pay taxes and finish it off. But when it comes to input, I am dependent on somebody else. Sometimes it is monthly filer, sometimes it is quarterly filer. Some rules were there earlier, how to claim the credit. Then the rules underwent a change couple of times. And we are facing this biggest challenge of bogus billing. And we have seen additions happening, income tax, in GST, and for somebody's act, the honest SSCs are punished. But I think we have, worthy speaker in the form of Abhay Bhai, who will guide us and what precautions we can take on both these issues. That guidance is very, very important and very, very useful for the ongoing season of GST 99C. Before we file 99C, I think this session will play a vital role. Once again, welcoming all of you to this online litigation series, and thank you so much. Over to you, Bishan Bhai, again.
Thank you very much, Ketan sir, for being there to guide us and to take us to a newer heights. Sir, under your visionary leadership, I just want to say that we all are flourishing, and thank you so much for guiding us from front and with Vice Chairman of the WRC, CA Piyush Chandak ji. Now it is time to know much more about Abhay Bhai. Abhay Bhai, you do not require any introduction, but as people rightly said by Vice Chairman, and what is the goal of this WRC, that we want to reach to last mile of the region and last to the each and every member. And sir, I just want to inform you that a member from Junagadh also called me and said that I have not received link, and we made it available to him. And that's how the participants are from each and small cities also join to listen to our learned faculties and to take benefit of it. Bye bye. We are seeing you on YouTube also while you are appearing before the High Court. But yes, it's great pleasure to listen to you and your wisdom. I request CA Labdisha to give a formal introduction of learned faculty. Thank you. Labdi, over to you. You need to unmute yourself.
Thank you so much. It's my pleasure to introduce our learned faculty, CA Advocate Abhay Desai sir, who is the founder of Desai Legal and who has presented for more than 1,000 cases in Tribunal, Supreme Court and High Court, whose more than 700 articles has been published and who has contributed thoroughly in CTC and ICI committees. So, sir, it's our pleasure to have benefit of well-tuned experience knowledge. Thank you so much, sir. Please have sit.
So, Abhay Bhai, the floor is yours. So, I request you to start with your deliberation. Thank you very much.
Thank you so much. First and foremost, I am grateful to Ketan Sayya Saab, Piyush Chandak Saab, my very dear friend, Bishan sir, Labdi madam, to the fellow professionals who have joined this webinar. It is indeed my pleasure and honor, and I am thankful to WIRC for considering me and allowing me to share some of my thoughts on the topic. Before I start the deliberation, let me just start the slideshow. Right. So friends, the whole idea of today's session is to cover issues related to input tax credit. We are going to deal with several intricacies that one faces while dealing with this subject. As the chairman sir rightly put it in his opening remarks, we are also going to deal with the precautions which are required to be kept in mind while making the claim of taking the credits. We are also going to look at the risks which are associated in a situation where one finds that the suppliers with whom we have transacted have been declared as non-genuine by the department, and basis that actions are taken to recover those credits. We also will deal with the issue of fake invoicing, and lastly and equally importantly, how do we handle the notices which are issued by the department for recovering the input tax credits. So this would be what we intend to discuss. Now, before I take you to the topics, let me just put a caveat, and this is the quote that I like a lot. Essentially, these words were expressed more than 3,000 years back, but it rings true in the present context. Essentially, what it says that the rules in the handbook or any of the kind of books that we deal or come across would not be capable of making us perform brilliantly. It is ultimately the practice that will make us achieve those heights. So essentially, when we deal with the cases, it is the manner in which we look at the notices, the manner in which we respond to those notices, and the experience that we gain through those processes is what ultimately creates knowledge, which we can eventually also apply in various similar situations that we come across in our professional life. So essentially, the knowledge that we gain from the reading, we need to apply that knowledge on a consistent basis in the cases that come before us, in the problems that the clients bring to us. And it is the application of the knowledge which eventually strengthens it, crystallizes it, clarifies it, and essentially that is what helps us in delivering the value-added services to our clients. So with that, let me start with some fundamental points, and then we'll go to the intricacies. So the first point or the first question that arises in everyone's mind is that this right of claiming the input tax credit, what is the nature of this right? Is it a constitutional right? Is it a statutory right? And if it is a statutory right, then how far the right is required to be upheld when there is a dispute as regards the veracity or the justifiability of that right? So essentially, everyone will now agree that it is not a constitutional right, because nowhere in the constitution of our country it says that there is a fundamental right with the citizens or the taxpayers to avail of the input tax credit. Essentially, the constitutional amendment which permits the parliament and the state to make the GST law essentially says that it is a power given to frame the law to levy a tax on supply. So essentially, the power is given by the constitution to the parliament and the state to make a law on supply. It is while framing that law that the parliament and the state thought it fit, considering that the law which is framed is based on the concept of value addition, that a taxpayer should be permitted to avail of the input tax credit on their inward supplies, which are further used in the business on which tax is leviable. So essentially, it is a right flowing from the statute. As you are aware, Section 16 of the CGST Act creates the statutory right. Section 16(1) essentially says that it is a registered taxpayer which is granted this right to take the input tax credit. So as far as the first question is concerned, the answer is that it is a statutory right, not a constitutional right. We have this series of judgments that you can see on the screen, where the Supreme Court, in a context of the pre-GST era, has held that this is a statutory right, not a constitutional right. But at the same time, Supreme Court has also appreciated that it is a substantive right. It is not a procedural right. So in a sense, the courts have said that since the idea is to grant the input tax credit so that the cascading effect of taxes is neutralized, and by denying the right of claiming the credit, the tax should not become part of the cost of the goods or services which are supplied, on which again the taxes are paid, essentially resulting in a situation of levy of tax on tax. It is to avoid this situation, to achieve the objective of putting a tax, a design of a tax, which is consumption driven tax, where essentially the entire burden of the tax falls on the end consumer and all the intermediaries in the chain of value addition, be it the raw material manufacturers, the intermediate manufacturers, the distributors, the dealers, etc. They all are able to pass on the tax which is collected at the earlier stages of the chain of value addition till the end consumer. And essentially, with that design in mind, the courts have held that since it is a substantive right, a situation if it arises where a substantive right is pitted against situations where there are certain deficiencies at the end of the taxpayer in claiming those rights, then the law says that it is a substantive right which will have to be upheld, and the procedural irregularities or infirmities should not be the cause for destroying this particular substantive right. So that is essentially what flows down. The courts have strictly interpreted this right in the sense that it is a statutory right, and therefore, as far as substantive conditions are concerned, substantive conditions will have to be complied with by the taxpayer. Only in that situation, the taxpayer is able to ascertain or assert this right. And in that situation, the procedural infirmities or deficiencies should not be the reason to deny the benefit. That is essentially what the ratio of all these decisions that you can see on your screen is what the courts have held. And in the context of GST, if you see when the CGST bill was introduced in the parliament, it was specifically indicated in the statement of objects and reasons that the idea of bringing GST in our country is to avoid the cascading effect of taxes, to transfer the taxes across the chain of value addition, essentially to provide for a seamless transfer of the taxes. And it is in that spirit that this statement becomes relevant, because in future when we will see the disputes that will arise on this particular aspect, the statement of objects and reasons will play a very vital role in terms of interpreting the ambiguities. And as I indicated earlier, in a situation where the judicial authorities find that the taxpayer has substantially complied with the requirements of the law, then this objective of allowing the credit will have to be upheld, and it cannot be defeated on the basis of any procedural or minor violation. So that is what even Supreme Court holds in Varkish, where the Supreme Court says that the statement of objects and reasons which are made by the Honorable Finance Minister while introducing the bill in the Parliament would carry a weight, and therefore when it comes to resolving ambiguities, it is that object which is indicated to the Parliament for bringing that law is what will be seen and looked at by the courts to take a view further in that object, instead of taking a view which defeats that object. So that is why this statement of object becomes relevant. Then we have section 155, which deals with the statutory burden of proof. Essentially, as you are aware, the concept of burden of proof has evolved over the period of time. When it comes to the levy of tax, the law provides for the levy. Law provides for a mechanism for collecting the taxes. However, the subtle law is that the burden is on the revenue to ascertain and assert that there is a levy which is attracted in a given situation. Only once that burden is discharged by the revenue, then the onus is on the taxpayer to say that that particular transaction is not leviable to tax. So as far as levy is concerned, as far as classification is concerned, as far as valuation is concerned, as far as penalties are concerned, as far as invocation of extended period is concerned. So these are all the situations where the courts have held that the burden is on the revenue. It is for the revenue to satisfy that that particular situation exists, that that particular levy is attracted, that that particular undervaluation has happened, and only when that burden of proof is discharged based on a cogent evidence, it is then that the taxpayer is required to discharge the onus by rebutting the allegations which are framed by the revenue. However, there is an exception to this general rule. The exception is when there is a statutory reverse burden which is put by the lawmakers as part of the statutes. So that is where section 155 comes in, where statutorily a reverse burden is created, where the Parliament says that in a situation where one claims the input tax credit, then the burden is not on the revenue to say first that the taxpayer is not entitled for the credit. It is the burden is on the taxpayer, the claimant, to say that the claimant is eligible for the input tax credit. So this is very important. So in any dispute that one comes across on the subject of input tax credit, one has to be very clear in making their submissions before the authorities to say with cogent evidence that they have discharged this burden which is casted on them under section 155, and it is only then that the revenue will be asked to see in the show cause notice as to on what basis the revenue has alleged that the credit in question is not eligible. Now, the concept of burden of proof is not something which asks the taxpayer to do the impossible. The concept of burden of proof, what we are discussing, is the legal concept. And therefore, there are two important principles that one has to keep in mind while interpreting section 155. One is, of course, we have the subtle principle of law that taxpayer cannot be asked to do the impossible. We have series of judgments from Supreme Court across various domains, not just limited to the fiscal law, where the doctrine of impossibility has been applied, and the Supreme Court has taken a view that the law has to bend to a situation which creates an impossibility for the taxpayer in this particular case to comply. And that is where we find that this concept, as we will also see later on when we deal with intricacies, that this doctrine of impossibility has been applied by Indian courts while looking at certain provisions related to input tax credit, essentially where, as initially was indicated by Chairman Sir, essentially where the recipient has been compliant with the law, but the default has been committed by the suppliers in depositing the tax which has been collected from the recipients, and that is where this doctrine of impossibility gets attracted. So when one comes across the question of burden of proof, first important exception is the doctrine of impossibility. A burden of proof provisions cannot be so strictly interpreted so as to make the taxpayer do something which the taxpayer cannot do or is impossible for the taxpayer to do. That impossibility exists either because of the acts of God, or impossibility exists because the taxpayer does not have a control over the actions of the other parties, without whose details, or without in absence of their facts, the taxpayer is not able to establish the veracity of the facts in question. So that is first exception to this concept of burden of proof. Second exception, again very important, is that since we are discussing legal burden, one cannot expect the taxpayer to do the impossible. From that it flows that what is something which is possible. So that is where one has to look at section 16. So what section 155 mandates is that what the taxpayer has to comply is the provisions of law enshrined under section 16. The revenue cannot ask the taxpayer to do something which is not there in section 16. So in instances where we will see later on cases where the revenue makes a case that merely based on a mismatch of input tax credit with 2A, you reverse the credit and we will issue the show cause notice to recover the differential amount. Is there a legal obligation under section 16 to do the matching of your claim of credit with 2A, especially prior to the amendment of section 16(2), whereby this clause AA was inserted only with effect from 2022. So question arises, was there an obligation to do this matching prior to the amended provision where there was no such requirement that the supplier in question should furnish the details in the return, and those details should get auto-populated in the return at the end of the taxpayer claiming the credit? In absence of such legal obligation under the law in section 16, one cannot resort to section 155 to say by the revenue that the taxpayer has not discharged the burden, because there was never such a burden in law to be discharged in the first place, so as to say that there is a violation of section 155. So these two important exceptions are to be kept in mind. One is doctrine of impossibility, and second is when it comes to burden, it is a legal burden that one has to be aware of, and legal burden is what in our context comes under section 16. Nothing beyond section 16 can be expected by the revenue so as to allege that in absence of that compliance with that requirement which is not flowing from section 16, there is a breach of section 155. So these are the two important caveats that one has to keep in mind while interpreting section 155. Then the last topic before we deal with the intricacies deals with the conflict of certain provisions of the law with the fundamental rights. Now, as you are aware, our constitution grants certain fundamental rights which are inalienable. No law can be passed which defeats the fundamental rights or which abridges the fundamental rights. In fact, if you look at the Constitution, Article 12, the definition of state is very wide to include the legislature as well as the executive. So any action taken by the legislature or executive which violates fundamental rights will be deemed as void. It will be deemed as invalid in law, and therefore those actions will not survive, and therefore no liability can be fastened on the taxpayers basis those invalid or void actions. Now, in our context, Article 14 first becomes relevant. Article 14 basically deals with the equality clause. It says that no law should be formulated which results into inequality. We have seen that this doctrine has been expanded by our Supreme Court over a period of time. Initially, this doctrine basically was applied in the context that the law should not create a class without any rationality or without any reasonable basis. And if the law creates a class which is discriminatory, where one set of subjects in one set of class is accorded a treatment which is distinct from second set of subjects which form part of the second class without any reasonable basis, then Article 14 gets attracted, and then it can be said that that law which discriminates actions qua these two separate classes would be on the teeth of Article 14 would be void. Then we have seen the Supreme Court has also then over a period of time evolved the doctrine of manifest arbitrariness, where the courts have said that look, if you create a provision which results into a situation which is manifestly arbitrary, in the sense that you are putting the taxpayer to do something which is impossible for the taxpayer to do, and therefore giving subjectivity or subjective powers to the officers to decide basis their likings as to in what cases they feel that the requirement of law is satisfied and in what cases they feel that the requirement of law is not satisfied. If that is the expectation of the law, then that law will be considered as a manifestly arbitrary law, and therefore then that law also can be said to violate Article 14. And recently we have seen Supreme Court expanding that doctrine and bringing in the concept of proportionality. But the courts are saying that there is a mischief which is sought to be cured by the law or by an amendment made in the law. But while curing that mischief, it should not happen that it results into a disproportionate consequences. So a law with a particular objective of curing a mischief has to be proportionate to the mischief which is sought to be cured. So in a situation where recently we have seen Gujarat High Court and Bombay High Court in the context of Rule 9610 was dealing with the validity of that rule. And while dealing with that validity of the rule, one of the contention was that this rule, as was in existence in the relevant point of time, violated this doctrine of proportionality merely because if one of my imports is with the exemption of IGST, then the rule indicated that my entire refund on exports becomes invalid. And therefore, the rule, although wanted to maintain that harmony between the claim of exemption qua the claim of refund, results into a disproportionate consequences, resulting in the denial of the entire refund claim. Even if only one of my input has enjoyed the exemption and on rest of the inputs or input services, I have paid the applicable tax and availed of the input tax credit. So there the courts have seen that application of that doctrine. However, since the Rule 9610 was omitted, and therefore the courts, both the high courts have ruled that in view of that omission without a saving clause, no pending action will survive, and therefore they have quashed all those pending proceedings. So that is where Article 14, that is how Article 14 has expanded. It also will be relevant for us because even in the context of Section 16, we will see that Section 16(2)(c) creating that situation of doing the impossible by establishing that my vendor, my supplier has actually paid the tax is something where Article 14 applies. Recently, in fact, Supreme Court gave a very good judgment. We will discuss that judgment, where in the context of Delhi VAT Act, the Supreme Court has taken a view that if the revenue does not dispute the veracity of the transaction, does not dispute the genuineness of the transaction, then revenue cannot recover the tax credit availed by the buyer merely because the seller has not paid the tax. So that is where again the Delhi High Court applied the doctrine of impossibility, applied the test of manifest arbitrariness of Article 14, and held and had read down that provision under section 9(2)(g) of the Delhi VAT Act, and those judgment has been upheld by the Supreme Court. So in essentially that is where again in our context of section 16(2)(c), the same propositions would be equally relevant. Then Article 19(1)(g) talks about the right to carry on the business. At times, if the actions of the authorities are hugely disproportionate in terms of recovering the input tax credit, which ultimately arbitrarily results in putting my business at risk, then again a cause arises for saying that those actions violates Article 19(1)(g). And then we have Article 21, not much relevant as far as the civil right of claiming the input tax credit is concerned, because this deals with the right of non-self incrimination. Essentially, it would be relevant more in the context of prosecution cases where someone is alleged to have taken fraudulent input tax credits, and basis that a prosecution is initiated. It is in those situations that if the revenue does not comply and merely bases their action on the statement given by the taxpayer, self-admitting that he has fraudulently claimed the input tax credit, then whether that statement is adequate enough to initiate that prosecution, it is in that context that Article 21 becomes relevant. So this is essentially the fundamental aspects that one has to keep in mind while dealing with the issues. Now let me take you through certain issues which I feel are very important and fundamental, in the sense that the ratio that we will derive from examining those issues would be relevant even in similar situations that one may come across, because in a 1.5 hour, 2 hour session, it is not possible to discuss each and every possible situation that one will come across. In fact, many of you will agree that 80 to 90% of the litigation happens on this subject of input tax credit. And there are so many situations which are there every day, which comes before all of us in various forms and in various flavors. And therefore, what I propose to do now is to deal with some fundamental situations, and then we can apply that ratio. You can apply that ratio in a similar situation that you will come across. Now, section 16(1) essentially gives the right of taking the credit, but it says the right is available when those inward supplies are to be used or intended to be used in the course or furtherance of business. Now, the business word is defined. We have section 2, clause 17, which defines the business very broadly, in the sense that it includes not only the main activity, but all kinds of incidental and ancillary activity. Issue arises is whether the officer can is right in saying that in his opinion or her opinion, certain inward supplies were not necessary for doing the business, or were not required for doing the business, or does not have a direct nexus with the sales, in the sense that by incurring this additional expense, you have not increased your turnover or you have not increased your profitability, and therefore can the officer or can the revenue deny the claim of input tax rate on that ground. Now, if you look at the word business, it says the section 16(1) says not only the credit qua the business, but in the course or furtherance of business. So essentially, a business is a entire gamut of the apparatus or the activity which is undertaken by the taxpayer, and therefore any inward supply qua that activity will pass the test of section 16 subsection 1. It would not be right for the revenue to say that that expenditure necessarily has to directly result in increase in sales or directly result in increase in profit. So we have this judgment of Supreme Court in the case of Malayalam plantations, where the Supreme Court has interpreted the word business very broadly and says that whenever the law creates a right qua business, officer cannot look at the nexus of that expenditure with the sales or with the profit. Officer has to look at the at the nexus with the entire activity as a whole. And therefore, if in the eyes of businessmen, if expending that money was felt as a requirement for the purpose of carrying that activity, then the officer cannot substitute businessman's judgment with his judgment to say that in his eyes that expenditure was not required or was not necessary. So essentially, we have seen cases where expenditure incurred on maintaining the gardens in the factory premises, expenditure incurred on constructing residential colonies, expenditure incurred on looking at the new business opportunities, engaging marketing consultants, spending money on availing those services, and then eventually abandoning those projects, expenditure incurred on starting with a project, going halfway in the project, and then deciding to abandon the project because of unviability of those projects. So these are all the situations where the revenue cannot say that those expenditure, the credit on those expenditure will not be available because it has not increased your sales, or it has not resulted in sales, or it has not resulted in your profits. Because one has to look at the nexus with the business, and as I indicated, not nexus with the sales or with the profits. Similarly, we have this judgment of Bombay High Court in the case of Coca-Cola India, where again the Bombay High Court very broadly looks at the term business. So expenditure like CSR, the corporate social responsibility. Again, revenue cannot look at section 16(1) and say that you are doing a CSR activity where you are spending money on constructing a school near your factory premises or near your office premises, or you're doing some other kinds of philanthropic activities, and therefore it has no correlation with the business. That would not be the correct view, for the reason that now the businessman in today's day and age has to not only look at the stakeholders in the terms of customers, employees, and the government, but today the entire society has a stake in the business, because now in this day and age we are moving in a direction where a businessman has to look at his business, viability of his business from the point of view of multiple stakeholders, which includes the larger society. And therefore, the businessman cannot neglect the larger society and only narrowly focus on only his customers or his employees or persons who are directly connected with the business. And therefore, if the businessman feels that in the locality in which he is running the business, essentially to support the business or to ensure that the business can flourish, if the businessman feels that there is a necessity of creating a social infrastructure as part of CSR, essentially it has a linkage with the business, because ultimately the businessman is taking care of the society as a stakeholder, as a part of his business activity, and therefore revenue cannot say and turn around and say that this is not in the course or furtherance of business. So the language is very broad, and therefore the test which is to be applied is that in the eyes of businessmen, was that expenditure incurred? If the expenditure is incurred, and if it forms part of the records of that business, essentially, to my mind, it passes the test of section 16(1), and therefore only if it is blocked under section 17(5), that we will see a little later, only in those situations the claim of credit can be denied. Otherwise, the officer cannot sit in the shoes of the businessman and decide qua that from that perspective whether that particular inward supply qualifies for credit or not. So this is the fundamental principle that you should keep in mind while dealing with whether one is entitled for the credit under section 16(1) or not. And 16(2) puts certain conditions basis which the entitlement of the credit gets decided. First fundamental question that arises is that whether these conditions are to be complied before making a claim of credit, or these are to be complied after making the claim of credit. Essentially, section 16(2) is silent as to how those conditions are to be applied, at what stage those conditions are to be applied. One has to read the law in the context, and therefore, as we will see now, for every clause, one has to see at what stage that condition will have to be complied, considering the reality in which we live. So first clause deals with the possession of document. Clause A says that one should be in a possession of a tax invoice or a debit note or the prescribed documents. Essentially, those conditions has to be complied before making a claim of input tax credit. Question here arises that if let us say there is a requirement of e-invoice, because now the e-invoice threshold is now lowered to 5 crores. There are certain suppliers who might be uh, obligated in law to generate the e-invoice, but they may not be generating the e-invoice. Now, can revenue tomorrow say that in financial year 24-25, some of your supplier was required to generate an e-invoice, not generated the e-invoice, and therefore the tax invoice which you have is not a valid invoice, and therefore the credit of the of the tax charge on that invoice would not be available because you have violated section 16(2)(a). Now, the answer to this question would be, I will again go back to the first initial discussion that we have had, that the law grants a substantive right in terms of claiming the credit. You have seen the judgments where the courts have said that when there is a substantive right is pitted against a procedural infirmity, then it is a substantive right which has to prevail. And therefore, when we apply that principle, merely because my supplier has not generated the e-invoice, but he has otherwise generated a valid tax invoice, where he has otherwise deposited the tax, and that is not in dispute, then in those situations, it would not be right for the revenue to say that merely because e-invoice is not generated, the condition under clause A of section 16(2) stands violated. Then double A, as I was discussing earlier, this was the requirement which was brought into effect from 2022. Prior to 2022, this was not the requirement, and therefore all those cases prior to 2022, where the revenue alleges that there is a mismatch with GST at 2A, and merely on that basis invokes section 16(2), in my opinion, the revenue would not be right in saying that merely on the basis of mismatch, they get the right to recover the credit. The requirement of matching the credit came into existence only from 22, that is 1st January 2022, where this clause AA creates that obligation that the concerned supplier has to furnish the details of the outward supplies, and those details are required to be communicated to the recipient. And in absence of this requirement prior to 2022, a law cannot be read in a sense to say that this substantive amendment is a clarificatory amendment or a retrospective amendment. It is necessarily a prospective amendment. And therefore, in absence of such requirement prior to 2022, merely on the basis of mismatch, one cannot recover the credits. Then clause B, again a substantive condition, essentially says that the taxpayer should have received the goods or services. Explanation provides that in a situation where there are bill to ship to transactions, or in the context of services also where there is a bill to ship to services, then the explanation says that it will be deemed that the bill to party has received the underlying goods or services, so that the bill to party is able to avail of the input tax credit and utilize the input tax credit against the invoices that they have issued to the ship to party. Because bill to ship to model, it's a recognized model of doing business, not only related to goods, but even in cost of services. We have now intermediary of services who are doing the intermediary on a principal to principal basis. And therefore, it is in this context that this explanation becomes relevant to say that revenue cannot deny the claim of input tax credit merely because physically the party would not have received the goods or services. Now, clause B also is silent on whether it is essential to receive the goods or services at the registered premises. The answer is no. As long as clause B says that the taxpayer claiming the credit has received the goods or services, it might be possible that a taxpayer might be registered, let us say in Maharashtra or Gujarat, has some project in some other state, like let us say Odisha, and avails of certain services, and the invoicing of that services is received in Maharashtra because the place of supply as per law is Maharashtra. However, it is possible that because a project was there, so physically the service might have been performed there. Can the revenue deny the claim of credit on the basis that you have not received the underlying goods or services in Maharashtra? The answer would be no, because essentially, if I am able to satisfy that I have actually received the goods or services, then irrespective of the place in question, I should be able to avail of the input tax credit. This is, of course, has to be read in the context with the concept of distinct person. So if I am registered in Odisha, and if Odisha becomes a distinct person, then we have the fiction created by law in terms of section 25, subsection 4, where it says that distinct person would be treated as separate persons for the entire purposes of the act. If that law, in that context, if in Odisha you have a registration, and if Odisha has purchased those goods or services, then it would not be right to take the credit in Maharashtra, when the fact is that the registered person who has received the goods or services would be Odisha. So one has to look at the contract, one has to look at how the registrations have been obtained when a situation is that one has more than one registration, and essentially then we have to apply this clause B to determine as to who is the or which is that registered entity, which is that branch where the condition of clause B stands satisfied and therefore would be in a position to avail of the credit. Then we have this condition BA, small BA, which was introduced in 2022, which has been brought into effect, but essentially it is not yet effective, because it essentially says that even if the details of ITC input tax rate are communicated, the power is reserved by the government under section 38 to prescribe certain restrictions where the credit would still not be available. Till date, no such restrictions have been prescribed by exercising the power. But in future, if some restrictions get prescribed under section 38, then this clause BA would get triggered. And in those situations, qua those restricted credits, the same would not be entitled. Then clause C, subject to the provisions of section 41, the tax charge has been actually paid to the government, either in cash or through utilization of input tax credit. We will look at this in the next slide when we look at the legal judgments on this entire aspect of clause C. And clause D has furnished the return under section 39. So that is one of the conditions made for the purpose of entitlement of the credit, that you should have furnished the return under section 39. Here I will pause and I will look at the scenario where, let us say, since we are dealing with intricacies, let us say a registration of a person has been cancelled because of non-filing of the returns last year. He has moved the application for restoration. Because of limitation, it has been dismissed. He filed the appeal also was dismissed. He has approached the court has directed the authority to restore the registration subject to the payment of the dues. Now in that context, if let us say this person today files the return, let us say if the returns are to be filed for financial year 23-24, then the time limit under section 16(4) to avail of the credit has already expired. For 24-25, it will now expire at the end of this month. So in those situations, what happens to those claims of input tax credit which are communicated in the returns which are filed beyond this statutory period which is prescribed under section 16(4). Now, that is where the interpretation of this clause D would become relevant. Now, if you listen patiently to what I am going to say next, if you see and think carefully, clause D provides a condition for entitlement of the credit. Clause D says that that person should have furnished the return, and then that person can be said to be entitled for the credit. As against section 16(2), I will at this stage pause and take you to section 16(4). Since we are dealing with this, let us put an end to this dispute. Section 16(4) says that a registered person shall not be entitled to take the input tax credit. So essentially, the limitation applies at the stage of taking the input tax credit. Section 16(2) deals with the conditions for the entitlement of the credit. Now, if you harmoniously read these two provisions, the view that emerges is like this, that I have to take the credit in my records as long as I am able to demonstrate that I have taken the credit in my records within the period prescribed under section 16(4). So in our example for 23-24, if I have already booked those inward supplies in my records that I am maintaining, and I have availed the credit in the registers that I am maintaining on those records, either manual or electronically I am maintaining those records, then in that situation, I can say that I have satisfied the requirement of 16(4). I have taken the credit as per the records which I am maintaining under the law within the permissible time limit. Now, for the purpose of entitlement, for the purpose of final entitlement of that credit, That is where section 16(2) condition D comes into play, which says that I should have filed the return. So on the filing of return, I become entitled to that credit, in the sense that I am entitled to now utilize that credit or claim the refund of that accumulated credit in accordance with the provisions of the law. And it is this distinction which is brought out by section 16(2)D vis-a-vis section 16(4), that the view that emerges is that as far as 16(4) is concerned, one has to take the credit in the records that one is maintaining. 16(2)D decides the final entitlement of that claim qua the other provisions of the law, and that is where the person is able to utilize that credit. So that is how, otherwise section 16(2)D, the condition placed by this clause becomes redundant, because if this is the case that I have to furnish the return and then only I can take the credit, then 16(2) would never have used the word no registered person shall be entitled to the credit. Then 16(2) would have used the word no registered person shall be entitled to take that credit, which is the terminology that we find in 16(4). So this is the distinction that creates this view that by putting this additional requirement of clause D for the purpose of determining the entitlement, and therefore the parliament has visualized two distinct stages of taking the credit on one hand and determining the entitlement on the other hand. And therefore the furnishing of return is for the purpose of determining the entitlement and not for the purpose of taking the credit. So that is how harmoniously one can construe section 16(2)D with section 16(4) to arrive at this view. Then we have these circulars. I'm not going to take much time. These are more on the administrative side, where the circulars have been issued by the board saying that in a situation where there are mismatches and there are certain reasons for those mismatches, then for the initial period of GST, the circular has indicated that you can obtain a certificate from the supplier, or where the disputed amount, the differential amount exceeds 5 lakhs, certificate from the practicing chartered accountant that the supplier has paid the tax. And basis those circulars, basis those evidences, the officers have been directed to permit the claim of the credits. But that is again, of course, subject to the caveat that those mismatches can be a legal ground to deny the credit. As we already discussed, prior to 2022, a mismatch would never be the legal ground for the purpose of denying the credit. Then we have section rule 37 capital A, which has been inserted from December 2022. Essentially, this rule now brings in place section 16(2)C and applies section 16(2)C qua the filing of GSTR 3B. Essentially, the mechanism under rule 37 capital A now says that how do we, because as I indicated earlier, it is impossible for the buyer, for the recipient to satisfy to the officer that his supplier has actually paid the tax. The only fact which is available with the buyer is the fact that the supplier has admitted the liability in GSTR 1, and therefore it is auto-populated in GSTR 2A or 2B, and the fact that the supplier has filed the GSTR 3B. Beyond these two data, satisfying section 16(2)C by the officer by expecting some additional proof is impossible to comply. So looking at this impossibility, looking at the Supreme Court judgments where the Supreme Court has said that this impossibility can never be the ground to deny the credit, the government inserted this rule 37 capital A with effect from December 22. And now the rule says that the recipient has to only look at the GSTR 3B. If the recipient is able to satisfy that the supplier has filed GSTR 3B, then the recipient would be said to have discharged the onus of satisfying the condition under clause C. And therefore, to that extent, the revenue cannot dispute that claim of input tax credit under clause C on the basis that while examining those 3B returns, it has been found that those suppliers have discharged the liability by either using some fraudulent credits or by using some ineligible credits. So as far as condition C is concerned, now rule 37 capital A brings a mechanism which now gives a distinct verifiable fact of filing the return as a criteria to examine the applicability of that condition. Prior to 2022, December 2022, in absence of such mechanism and in absence of that, and because of that impossibility of proving that the supplier has paid the tax, in a situation where the genuineness of the transaction is not disputed, and only clause C is invoked, then one can very well argue that in such situation, the recipient cannot be made liable to reverse the input tax credit or recover those input tax credits. But please understand, I am discussing a situation where the violation of clause C is alleged. If the violation of clause B is also alleged, which happens in a situation where the allegation is based on fake invoicing or non-genuine taxpayer, in those situations, the taxpayer has to not only satisfy the requirement of clause C, but more importantly, one has to satisfy the requirement of clause B. In those situations, it is quite possible that those suppliers would have filed 3B, and therefore clause C requirement would stand satisfied in view of this new mechanism that we have under Rule 37 capital A. But that by itself would not imply that there is a satisfaction of clause B also. For purpose of clause B, that is to prove that you have actually received the underlying goods or services, you will require the third-party evidences. Merely invoice and e-way bill would not be sufficient, because those are the two evidences which are generated by the supplier itself. When the supplier's genuineness itself is doubted, when the supplier's existence itself is doubted, the proofs which have originated from such supplier would not be adequate enough to justify the fact that you have actually received the goods or services. That is why we see Supreme Court in the case of Ecom Gill goes beyond these two evidences of invoice and e-way bill, says that you have to also produce the transport details, you have to also produce the lorry receipts, you have to also produce the payment slips where they are available, you have to also produce such third-party evidences which will go and show that you have actually received the underlying goods. So in a situation where the allegation is violation of clause B of 16(2), please keep this in mind, that merely producing an invoice, e-way bill, or a ledger saying that you have paid the amount to the supplier through the banking channel would not be adequate enough in a situation where the genuineness itself is questioned, the existence of supplier itself is questioned. But in a situation where you come across where the show cause notice does not dispute the genuineness, or merely asserts that the registration has been cancelled retrospectively, and therefore the claim of credit is not available, there we have seen lines of decisions from the courts to say that merely this allegation that the registration has been cancelled retrospectively would not be adequate enough or sufficient enough for the revenue to dislodge the claim of input tax credit. So essentially, one has to study the show cause notice, exact allegation in that show cause notice. Is it alleging violation of clause B? Is it only alleging violation of clause C? And basis that, one has to respond to that notice. So this is where all these legal judgments will come handy. So on a mismatch, we already discussed. Already we have seen judgments where the high courts have taken a view that on the basis of mere mismatch, credit cannot be recovered. We have this Kerala High Court's view in case of DI agencies. Bharti Airtel, Supreme Court has taken a view that since this entire law, as far as claiming of credit is concerned, is in a sense similar to what was the law in the context of excise era, VAT era, and therefore those principles would be equally applicable, and therefore a mere mismatch with 2A would not be the ground to deny the claim. Then in a situation where clause C is only violated, there we have this latest decision in the case of Commissioner versus Shanti Kiran India Private Limited, where the Supreme Court examined the SLP filed by the department, the Delhi State State Authority, wherein the High Court had taken a view that in absence of disputing the genuineness of the transaction, the claim of credit under the Delhi VAT Act, under Section 9(2)(g) of the Delhi VAT Act, cannot be disputed, despite the fact that the provision was a para materia to what we have under Section 16(2)(c), in the sense that it also casted an obligation on the buyer to satisfy that the seller has actually paid the tax. In that context, Supreme Court examines this issue. Supreme Court says that already Delhi High Court in the case of on-quest merchandising has taken a view that mere non-payment by the seller would not be the ground to deny the credit to the genuine buyer. Supreme Court agrees with that view and rejects the SLP on merits by saying that the view which was expressed by the Delhi High Court is a correct view. So now I think with this judgment, As far as allegation of violation of clause C is concerned, now we have a definite view from the apex court, where the apex court has said that in absence of disputing the genuineness of the transaction, mere non-payment of tax by the seller, by the supplier, would not be the adequate ground to deny the claim of credit at the end of the recipient. We have Arise India, which was basically the on-quest judgment, which was earlier also SLP was dismissed. We have this Rajasthan High Court RS Infra, which have relied on the Delhi High Court judgment and held a similar view. As far as burden of proof is concerned, we already discussed the Ecom Gill judgment, where the Supreme Court has said that mere evidence from the seller would not be adequate. You need to also bring on record evidence from third parties so as to demonstrate the genuineness of the transaction. Once those evidences are brought on record, then the onus is on the revenue to say that those evidences are not genuine or those evidences are not true. And only in that situation, the revenue will have a right to recover the claim of credits. As far as the veracity of evidence is concerned, we have these judgments where the courts have taken a view, including Punjab and Haryana High Court in the Garima Enterprises case, where the courts have said that you cannot just say that just because the registration has been cancelled retrospectively and therefore will not look at all those evidences which you are producing, be it the transport evidences, the receipt, actual receipt of goods evidences, etc., etc. The courts have said that you cannot brush aside those evidences merely because you have painted the supplier or the seller with a single brush, in a sense to say that the seller is not genuine or is not undertaking actual or genuine transactions. Then we have seen cases where the supplier commits a fraud. Then in those situations also courts have taken a view that supplier might have committed a fraud with the transactions that he might have done with other entities. But that does not ipso facto mean that all transactions of those suppliers are non-genuine and therefore that cannot be the ground. So in a situation where, let us say, the revenue alleges that one of your supplier is a fraudulent supplier, records the statement, investigates the supplier, and issues you the show cause notice on the basis that you have violated section 16(2)(b), in the sense that you have not received the underlying goods or services. There, not only you will advance your evidences to say that you have received actually the goods, underlying goods, but you will also make a contention to say that, look, his statement or his investigation does not conclusively prove that his transactions qua you were also not genuine, and therefore a mere statement by your supplier to say that he was generally engaged in such activity would not ipso facto mean that all the transactions done by their suppliers become non-genuine transactions, fraudulent transactions, and therefore cannot give the revenue the right to deny the claim of input tax credits. This right of cross-examination, again, in a situation where, let us say, the credit is disputed on the basis that there is a violation of 16(2)(b), and there is a statement recorded of your supplier or your transporter or any of your intermediaries where they have averred in those statements that they have not actually supplied the goods, etc., etc., and you have an evidence which contradicts those averments, then you have a right of cross-examination, and that is the right which you have to seek. It is essential that you seek this right at the stage of adjudication, because that is where the adjudicating authority will have to weigh the relevance of those recorded statements vis-a-vis the statement recorded during the cross-examination. And if the cross-examination is rejected, then you have a very strong ground to argue that your evidences were required to be considered, and the statement basis which you requested for a cross-examination not granted, then cannot be the part of cannot be the relevant for the adjudicating authority to place any weight to determine whether there is a violation of clause B or section 16(2) or not. Then relied upon documents, many times we have seen that department revenue alleges that the credit is not available because those suppliers are not genuine, but does not give any proof as to how the department has come to that conclusion. No Panchnama is attached when department is alleged to have visited the place of your supplier. No findings are recorded, no order is shared of cancelling the registration of those suppliers, etc., etc. No show cause notice is copy of that is given to say that on what basis the revenue is making that allegation that the suppliers are not genuine, and therefore the credit of those purchased from those suppliers is not available in law. So it is in all those scenarios that you have a right to uh, receive all those relied upon documents basis which that allegation is framed against you. So as I indicated earlier, you will demonstrate from your end that you have satisfied requirement of section 155. At the same time, you will also demonstrate that in absence of any relied upon documents given to you, you are not in a position to dispute the allegation of the revenue. And therefore, in that set of circumstances, it can be said that you have satisfied the requirement of 16(2)(b), and therefore in that context the credit cannot be recovered. So it is in that context that these judgments which you can see on your screen would become relevant. If the show cause notice is vague, then again it is liable for dismissal. Many cases we have seen where 16(2) is alleged, the violation of 16(2) is alleged, but show cause notice fails to indicate as to on what concrete evidence there is a violation, and violation is of which clause of section 16(2). Has the taxpayer violated clause B? Has the taxpayer violated clause C, etc.? Show cause notice is completely silent on all these aspects, and therefore merely based on borrowed satisfaction. We have seen cases where show cause notice says that they have received a report from another commissionerate where the supplier was based, and that commissionerate has formed an opinion that those suppliers are not genuine, and therefore on the basis of that borrowed opinion, an allegation is made that the credit in question is not available. Now that borrowed satisfaction cannot be the ground, because your adjudicating or your show cause notice issuing authority and the adjudicating authority has to arrive at their own independent findings as to why based on that evidence the credit in question is not available and which of the clause of section 16(2) has been said to be violated. A borrowed satisfaction can never be the ground, and therefore in those situations the show cause notices are have been held to be completely based on assumptions, presumptions, and therefore those notices are not valid in law. Then we have seen cases that if the recovery is at all to be made, it has to be made from the supplier first. It can never be directly made from the recipient. Then we have seen cases where the show cause notice is completely silent on the allegation, completely silent on evidence, completely based on borrowed satisfaction. When all of that is countered, the order comes detailing so many additional aspects, bringing so many additional aspects in the order which were never alleged in the show cause notice, which were never indicated that these are the grounds for the purpose of disputing the input tax credit. Can those orders be sustained? We have this series of judgments where the courts have said that a show cause order cannot travel beyond the grounds indicated in the show cause notice. In fact, now we have section 75 subsection 7, which makes it very categorically clear that the order cannot be on any basis which is not there in the show cause notice. So therefore, in all those situations, the orders which then expand the scope of investigation, instead of adjudicating the show cause notice, the adjudicating officer becomes an investigating officer and expands the scope of investigation and travels beyond the contours, beyond the scope of notice, then those orders are again bad in law. So those are again the aspects that one has to keep in mind. There's the requirement of speaking order. As I indicated earlier, evidences that you indicate cannot be brushed aside just because the revenue is of the view that the so-called supplier is not existent. Revenue is required to apply the mind and decide the evidences which you are producing before the adjudicating authority as to how those evidences does not conclusively prove that you have satisfied the requirement of section 16(2)(b) or C. Then we have issues of jurisdiction, penalty. Now, as you are all aware, I can see there are so many participants in today's webinar, and I am sure all the participants will agree with me on this, that department always invokes section 74, the extended period. Now in this, from last year, now we have section 74 capital A, where again we have two limitations. One, normal period limitation of 2.5 years, extendable again, where there will be no penalty, and then extended period 5 years with penalty. In all cases, department invokes the extended period under 74 and now onwards will invoke the penal period under 74 capital A. Can that survive? We have seen so many cases. Now almost it's a settled law, but somehow it's very, it is not, the revenue is not able to accept those judgments, where the courts have said that unless the collusion is established, unless evidence is brought on record to say that you colluded with those defaulting suppliers or you were party to that fraud, you cannot be said to have suppressed any information or to have evaded the tax. Your claim of input tax credit was based on evidences which you are having, which still justifies the claim. It is only because the revenue has found some fault, some fraud at the end of the supplier that can never be the basis to invoke the extended period and to penalize the genuine recipient. So despite this settled law, still every show cause notice gives that assertion that in absence of the investigation or in absence of audit, etc., we would never have known this claim of input tax credit, and therefore there is separation, and therefore extended period is justified. That line of reasoning has been rejected time and again, and courts have said that that reasoning is not adequate to justify the invocation of extended period. Revenue has to produce some concrete evidence to say that the recipient was a party to that fraud. Only in those situations, the extended period along with penalty can be imposed. So that is how all these judgments have dealt with this situation. Inadvertent errors in 3B while making the claim of credit, can that be the reason to deny the claim? We already have this circular 26 which still survives, which permits the rectifications, and we have these judgments where the Supreme Courts have taken a view that, as what we already discussed earlier, that substantive right has to prevail over the procedural irregularities. We have this Gujarat High Court judgment in the case of Ramesh Bhai Solanki, where the Gujarat High Court has taken a view that there is a distinction between an illegality and an irregularity. Illegality is something where in substance the taxpayer is not able to satisfy the requirement of the claim. Irregularity is where in substance the taxpayer has satisfied the requirement. Only on the procedural front there is some kind of discrepancy, and therefore the law has to treat these two situations distinctly. An illegal claim at the root is illegal and therefore not admissible, but an irregular claim because of procedural defects or the manner in which the credit was shown in 3B, etc., cannot be the ground to deny the substantive right. And then we have Delhi High Court in the case of Instacart, Karnataka High Court in the case of Orient Traders, which have taken a view that such clerical errors, procedural errors, etc., cannot be the ground to deny the substantive right. Now we have this proviso to section 16(2), which gives that 180-day condition, where it says that if the payment is not made within 180 days, then there is an obligation created to pay that amount of input tax credit along with interest and then reclaim that credit as and when actually the payment is made to the concerned supplier. Question arises that what if my credit period is beyond 180 days? Can this proviso still get attracted? My answer is that proviso will not get attracted because the proviso uses the language when there is a failure to pay. A failure to pay arises only where under the contractual terms there was a liability to pay within a period of 180 days. In absence of such liability, the same cannot arise. Second, can this proviso go beyond the requirement of section 16(2)(c), because 16(2)(c) says that the moment I am able to satisfy that the tax has been paid by my supplier, I am entitled for the credit. Then can that entitled credit, once the revenue has received that tax from my supplier, can that be denied by way of this proviso to say that since I have belatedly paid my supplier, and therefore the credit in question will have to be reversed. We have seen many high courts are seized of this issue and of the validity of this proviso qua section 16(2), because provisos are supposed to carve out an exception to the main provision. Here the main provision says that once I pay the tax, credit is entitled. Then where is the question of proviso getting attracted and saying that just because you have paid late the consideration and the tax to your supplier, and therefore there is an obligation created to reverse the credit. So that is first issue. Second issue is this Rule 37, which operationalizes this requirement. Came into effect only from 1st October 22, where it says that this amount will have to be added to 3B. Earlier, there was a requirement to fulfill this obligation through GSTR 2. GSTR 2 was not operationalized, and only from October 22, that now that requirement under the rule was created to add it to 3B. However, the requirement under the law that this has to be added to the output tax liability through GSTR 2 was deleted in 2023. And now from October 2023, now we have the law and the rule in synchronity by saying that this amount will have to be paid. As far as interest is concerned, can that liability be imposed? There is a subtle law that interest forms part of substantive law. And therefore, the parliament has to create a specific provision for imposing the interest. I mean, this scenario, if you see the proviso, it says you have to pay interest with what is payable under Section 50. So Section 50 has to create that liability of imposing interest. And that is that liability which is then required to be paid by virtue of this proviso that you can see on your screen under Section 16(2). If you look at Section 50, till date, there is no such provision which creates a liability to pay interest on such payment where the taxpayer has delayed in making the payment to their supplier beyond 180 days. So essentially, in absence of any interest liability imposed by Section 50, proviso saying that you pay the interest which is payable under Section 50 would not be, in my opinion, adequate to create this liability or to fasten the interest liability on the recipient, even if the recipient is liable to pay this amount where the recipient has not paid to the supplier beyond this 180-day period. So this is the view that I indicated, that interest forms part of substantive law and therefore requires a substantive provision to create the charge. That view one can find in the celebrated judgment of J.K. Synthetics, where the Supreme Court has taken the view that interest provisions are substantive provisions, and unless specifically made, the interest cannot by implication get attracted. That decision has been followed in the case of Indian Carbon, and therefore basis this view, unless Section 50 creates that liability, proviso to Section 16(2), in my opinion, would not be adequate enough to create that obligation. 16(4) we already discussed. We already discussed that 16(4) applies at the stage of taking the credit and not at the stage of filing the returns. And therefore, as long as I am able to satisfy that I have taken the credit within the permissible period, I may not get into that larger debate as to whether 16(4) is valid in law or whether I need not question the validity of 16(4) as long as I am able to satisfy that I have taken the credit in my records within the permissible limit. Now we go to Section 17. So we have now Section 17, which essentially says that there are certain restrictions on claiming the credits. On one hand, even if Section 16 permits us to take the credit for any inward supplies which are in connection with the business, Section 17 creates certain exceptions and restrictions. Section 17(2) provides that the credit which is attributable to exempt supply would not be available. Section 17(3) says that the value of exempt supply will not only include what is normally an exempt supply in law, that is under clause 47 of Section 2, but also include certain Schedule 3 transactions subject to certain exceptions. And then Section 17(6) gives the government the power to prescribe the manner in which the restrictions under Section 17(1) or 17(2) would be applicable. So it is in that context that we have this entire mechanism of Rule 42 and 43. One first question that arises is that whether, since this mechanism works on the basis of ratio of turnover, at times it results into a scenario where a disproportionate amount gets restricted. So question arises is that whether taxpayer is at liberty to adopt some alternate scientific base to do this attribution of credit into what is qua taxable supplies and what is attributable qua exempt supplies. In my opinion, taxpayer can do that attribution. Taxpayer can attribute the credit qua taxable supply and only avail of that credit under Section 16(1). Once that stand is taken, then to my mind 17(2) will have no application, because what I have availed is completely towards taxable supply only. There is no common credit which is available with me, and therefore the question of applying the mechanism of Rule 42 or Rule 43 should not arise. We'll also look at this controversy a little later when in the recent amendment which has come in GST 2.0, where the hotel industry, the rates of tax have been revised, and there is a condition that the credit would not be available. So in that context, we'll again revisit this issue little later. Then we have 17.5, again creating certain restrictions. What I intend to discuss is mainly the restrictions related to clause C and D. Essentially, these restrictions applies qua the construction of an immobile property. Clause C applies in the context of inward supply of works contract services. Clause D applies in the context of inward supplies of goods or services. Essentially, the restriction applies only if those inward supplies are for construction of an immovable property. And then the law creates an exception to say that if that immovable property is in the nature of plant and machinery, then this restriction should not be applicable. And then clause D creates one more exception to say that if it is not on own account, then again this restriction would not be applicable. And then the explanation defines the expression construction to indicate that only what is capitalized would be considered as a construction, and therefore qua that expenditure, the restrictions would come in place. So essentially, this is the law that we have. Now, what are the issues? Issues are, we'll go one by one. First is, this restriction applies only if what is the subject matter of construction is an immovable property. Now, immovable property is not defined in the law. We have to take help of the Transfer of Property Act to understand this word. If you look at that law, you will find all those relevant references in the presentation, in this presentation, which I will share. But because of the limitations in time, I will in a nutshell explain how the courts have looked at this concept of immovable property. Courts have essentially applied two tests. One is time, another is damage. Which are those two tests? One is, if the intention is never to move, then in a foreseeable future, that is the time test, then it will be assumed that the property which is constructed is an immovable property, one of the factor. Another factor is the damage test, which the court say that if you have to remove that property and take it somewhere else, then it will cause a substantial damage so as to completely make the property unusable or substantially unusable, then that also satisfies that that property in question is an immovable property. So both these tests are to be applied. It is not just that just because the intention is not to move, so it automatically becomes immovable. One has to also apply the damage test. And if one finds that in those situations, the property which is constructed is not immovable, then the question of applying this restriction under clause C and D would be irrelevant. Those restrictions would not apply because those restrictions apply only qua immovable property. So if you are able to demonstrate that what you have constructed, the intention is to move it in a foreseeable future, then it is not immovable and therefore it comes out from this restrictive clause. Or if you can establish that by moving it, you will not substantially damage that property, then again it does not become an immovable property and therefore again these restrictions would not be applicable. Second, plant and machinery. Now there was a huge controversy. Many of you would be aware that earlier the law used the expression plant or machinery. We have a Supreme Court judgment in the case of Safari Retreat, where the Supreme Court has taken a view that the expression plant or machinery was not defined in the law. What is defined, as you can see on the screen at the last in the last bullet point, the explanation defines the expression plant and machinery. Therefore, Supreme Court applied the functional test to say that if something is so made technically that it plays a role in the business activity, then it would be considered as a plant, and therefore it would come out of this restriction. It would fall in this exception. The legislature said that it was an error in drafting, so they rectified that error with a retrospective effect, and now we have that exception saying that it is plant and machinery. This is made applicable from July 2017, and explanation 2 is added to say that this amendment would survive even if it is contrary to any judgment of the court. So essentially a legislative veto has been exercised to say that this is what was intended from day one, from the day GST was introduced. Having said that, does it negate the Supreme Court judgment in the case of Safari Retreat? Answer is no. Two important ratio of those decisions still survive. First is, if you look at the definition of plant and machinery, it uses the expression apparatus. Now, how do we define this expression? Equipment and machinery, that expression we can understand because those are standalone items which are either having a mechanical force or performing a particular role. But what about apparatus? Apparatus has been defined very broadly in the sense that whatever infrastructure that the businessman creates is an apparatus for that businessman for the purpose of undertaking those transactions. So it is there that the Supreme Court's test, the functional test, would be relevant to understand the word apparatus. So functionally, if one is able to justify that the nature of factory building, for example, is such that it supports the manufacturing activity, then it comes within that expression apparatus and therefore comes within the exception and therefore should be able to avail of the input tax credit and would not get restricted under this clause C or D. So that aspect of Supreme Court's judgment in the case of Safari Retreat still survives. Second aspect of Supreme Court in Safari Retreat still survives because in clause D, as we already discussed, another exception is carved out by saying that only if it is on the own account, then this restriction applies. So if I am doing the construction for someone else, then it is not on my own account and therefore the restriction would not be applicable. Now, in this context, what has happened that Supreme Court in Safari Retreat's case in para 33 comes out with the finding to say that if the intention is to lease out the building, then it is not on own account. It is akin to a sale transaction where the developer builder is developing the unit for the purpose of sale. Supreme Court has specifically held in this judgment that if it is for leasing, it is not on own account and therefore the restriction under clause D would not be applicable. So again, this exception gets carved out and this ratio of Supreme Court judgment still survives where if the intention of constructing an immovable property, even if it is held to be not in the nature of plant and machinery, but if it is for the purpose of leasing, then the restrictions under clause D would not be applicable because it is not on the own account and therefore the credit in question would still be available. Then we have these other clauses because of limitations of time. I think we can skip those clauses because I want to deal with some other important aspects also. These are the judgments, what I indicated earlier, the functional test, the timing, the time test, the damage test, which has been applied consistently by several courts, including the apex court, to determine the meaning of the expression plant and machinery. Now, this Apollo Tyres judgment is also very important, although it is in the context of income tax, but it has a much relevance in our context also because let us say your auditor is of the opinion that certain substantive repairs are to be treated as a revenue expenditure and therefore he has not capitalized it in the books of accounts. Now, as we saw earlier, the restriction under C and D applies only to the extent of cost which is capitalized. Therefore, issue arises that can GST officer say that according to his opinion, this cost is substantive in nature, was required to be capitalized and therefore hit by restrictions under clause C or D. Can that view survive? Supreme Court in Apollo Tyres says that when the law, fiscal law, frames the provision qua the entries in the books of accounts, then in that situation, the expert who is drawing those books of accounts, who is certifying those books of accounts, that expert's opinion will have to be upheld. And the revenue officer cannot sit in the position of an expert and redraw the books of accounts by taking a view that as per him or her, the expenditure should have been treated as a capital expenditure and not as a revenue expenditure. So that ratio of Supreme Court in the case of Apollo Tyres would be equally applicable in our context. And therefore, as long as the businessman is able to demonstrate that his books of accounts says that is a revenue expenditure, then the officer cannot sit in the judgment of those accounting entries or those accounting concepts and say that as per his personal opinion, the expenditure should have been capitalized and therefore the credit in question would not be eligible. As far as industrial plots on long-term lease is concerned, on the case of assignment of the leasehold rights, we have already seen you must have all been aware of the Gujarat High Court judgment in the case of Gujarat Chamber of Commerce, where the Gujarat High Court has taken a view that on that assignment transaction, no GST is applicable, it is not liable to tax. What happens if someone has paid the tax and availed of the credit? Can that be disputed? The answer is no. The restriction under clause C and D applies for the inward supplies for construction. It does not extend to inward supplies which are not having a direct nexus with the construction. So for example, if you are drawing certain plans before actual start of construction, or let us say you are paying a brokerage for acquiring the land on which you will construct the factory building or the office building, or let us say in this scenario you are paying for occupying the land, not for constructing the land. The construction is qua subsequent to the right of occupation. What is paid for is for occupying, not for constructing. So all those expenditures which are not having direct nexus with the construction would not fall within the restrictive provisions under clause C or D, and therefore in those situations the credit in question should be found to be eligible. So that is where I think we can end 17.5. 18 I'll just summarize, and then we look at 2-3 issues, and then I take you to the last aspect of how do we respond to the show cause notice. So section 18, again, special provisions created for the purpose of input tax credit. Essentially the provisions can be understood from 3 perspectives because it divides itself into 3 broad categories. One is it permits the taking of credit in some special situations, like first time you are obtaining registration, or you are converting yourself from a composition scheme to a normal scheme, or your supplies were earlier exempt and now found to be taxable. And in the second set of situations, it deals with transfer of unutilized credit in certain business reorganization arrangements such as sale, merger, etc. And then it talks about payment of certain amounts where you convert from normal scheme to composition scheme, or when something which was taxable becomes exempt, or where certain plant and machinery or capital goods on which you might have availed of the credit are sold within the period of 5 years. In that context, the provision creates a obligation to pay certain amounts. Now, this is where the dispute recently arises in the context of section 18, subsection 4, because it says that if some supply which was earlier taxable is found to be exempt, is made exempt rather, then in that situation it says that the taxpayer is obligated to reverse whatever input tax credit which has been availed qua the inputs in stock on the date when the supply are exempted, and whatever balance that remains in the credit ledger will also lapse. Now, this all situations arises, and now we have this recent change which has created a lot of disturbances in this hospitality industry. Essentially, what has happened with effect from 22nd September of this year, the accommodation services where the value of accommodation is not above 7,500 per unit per day, the rate of tax has been prescribed is 5%, with the condition that the input tax credit would not be available. And then we have the residual entry where it says that if the value of accommodation is more than 7,500, then the rate of tax would be 18%. And then we have the explanation which says that in a situation where your supplies falls under Roman 1, you are mandatorily required to follow that rate of 5% with the condition of not availing the credit, and you cannot have the discretion to follow the rate of 18% and avail of the credit. Although there is a larger debate as to whether that explanation can compel the taxpayer to remain under Roman 1 when the taxpayer is found to violate the condition, because if you violate a condition, the law says that it is on violation, you have to then be charged to a regular rate rather than forcing you to comply the conditions which you have violated. So that is a larger debate, but for us, what is important is, let us say you have a client which is a hotel. Now, obviously, prior to 22nd September, they would have purchased inputs, they would have purchased capital goods, they would be in stock, inputs would be in stock, capital goods would still be there, and useful life of 5 years would not have expired. Question arises is that now with effect from 22nd September, since now that hotel substantially would now be coming under that 5% category, is there a requirement to reverse the credit qua the balance useful life of those capital goods, qua the inputs which are in stock on the morning of 22nd of September, which are now being used for the purpose of rendering the supplies which will now attract 5% GST, etc. Now, why this question arises? Because there is an explanation. Because 5% rate is not an exempt supply. So per se section 17(2) does not apply. But this exception is what creates the problem. What the exception says, that where in this notification the rate is prescribed, which says that there is a with the condition that you cannot avail of the credit, then the explanation says that it shall mean that the credit of input tax charge on goods or services used exclusively in such supply of services has not been taken, and the credit of input tax charge on use of goods or services used partly for supplying such service and partly for effecting other eligible supplies is reversed as if such supply is an exempt supply and attracts the provisions of 17(2). So a deeming fiction gets created where even though this rate of 5% for the hotel, where the accommodation charges are not exceeding 7,500, is deemed as an exempt supply, and therefore the provisions of section 17(2) are sought to be attracted. Again, will this mean that my past credit claims are also liable for reversal or liable for working under 17(2) read with rule 42 or 43? My answer is this, that whenever law creates a deeming fiction is a fiction created by law, which is distinct from a reality. Settled position is that when a deeming fiction is created, it has to be strictly construed, because deeming fiction as such is something which is artificially created by law, not the reality of the world. So a deeming fiction provisions are always very strictly construed. Now, with that in mind, with that proposition in mind, to support this proposition, these judgments that Delhi Cloth and General Mills, Bengal Immunity Company, these are the judgments which have interpreted that deeming fictions are to be very strictly construed. Now, with this in mind, the question arises that how do we construe this explanation? Now, if you carefully read this explanation, it says it talks about present tense. It does not talk about past tense. It says that whenever the rate prescribed is 5%, so that happens on 22nd September, then the condition says that you cannot take the credit which are exclusively attributable to that 5% supply. So essentially it applies from 22nd September, not retrospectively. Clause B again uses the present tense. It says that even if you find that there are common capital goods or there are common inputs which are in stock on 22nd September, are they liable for reversal? The answer is no. Why? Because the clause B says that those common input supplies are required to be reversed. But what is required to be reversed? The credit which is taken. When the credit is to be taken, that is when the rate has been prescribed at 5% with the condition that I cannot take the credit. Now that event happens on 22nd September. So therefore, to my mind, the requirement of reversal can only apply prospectively. It cannot take away the vested credit which was already there prior to 22nd September. So there we have the judgment of Eicher Motors, where the Supreme Court says that on the date of taking the credit, if by law that credit was duly taken and vested with you, then subsequently, unless there is a specific retrospective intention of Parliament of taking back that credit retrospectively, the rule-making authority or the executive power cannot be exercised for the purpose of taking away the credits retrospectively. So that proposition would be squarely applicable here, Eicher Motors judgment, and therefore, to my mind, the hotel would not be liable for reversing the credit which has been taken prior to 22nd September 2025, be it in respect of capital goods or be it in respect of inputs. Post September 25, Rule 17(2) read with 42-43 would apply. It would apply because now we have this deeming fiction which seeks to treat this as an exempt supply and therefore apply the mechanism of Rule 42 and 43. Whether 18(4) will apply, 18(4) can never apply because 18(4) applies when the supply is declared wholly exempt. This is not a situation where the accommodation services have been declared as wholly exempt. They are still taxable and they are taxable at 5%. And there is no deeming fiction even under this notification which says that when the rate is declared at 5% with the condition that credit is not eligible, those will be equated as an wholly exempt transactions, and therefore, to my mind, section 18(4) would not become applicable, and therefore, to that extent, the requirement of reversing any credit which might be available in the credit ledger of the hotel on 22nd September should not be liable for reversal. And as going ahead, you can discharge the tax of 5%. There is no condition in law which says that 5% tax on accommodation services has to be discharged compulsorily from cash ledger, and therefore you can very well utilize the credit balance which would be available with that particular hotel for discharging the tax of 5% going ahead. Last issue that arises, again, this is something which GST Council will have to deliberate, and as I understand, the matter is also pending in the Supreme Court, where the automobile industry is facing the brunt, temporary brunt, but a huge substantial brunt, because now the cess has been subsumed in the GST. And for smaller vehicles, the GST rate has been reduced, but for larger vehicles, with subsuming the cess, the GST rates have been increased from 28 to 40%. Question arises that whether these automobile dealers are liable to reverse the cess credit which is available in their balance as on 22nd September. And the larger issue again arises that what about the cess credit which has been already utilized, but those vehicles are already in stock. So on 22nd September, I have 50 vehicles in stock. My credit of cess on those 50 vehicles, let us say, is 10 lakhs, but today I am only having a balance of 2 lakhs. Am I required to reverse 10 lakhs and pay 8 lakhs by cash because I only have a balance of 2 lakhs in the ledger, or am I not required to reverse 10 lakhs in that context? Now, question revolves around interpretation of 18.4. Now, 18.4 essentially says that applies when the supply is declared wholly exempt. Question arises that whether this action of the government has resulted in the supplies becoming wholly exempt. If you look at the exempt supply definition under clause 47 of section 2, it says exempt supply includes supplies which are exempt under section 11, which are nil rated, or which are non-taxable supplies, which are beyond the ambit of GST, the alcoholic liquor for human consumption, etc. So essentially, the 17.18.4 picks up only wholly exempt category out of those three categories and says that only in those situations 18.4 gets attracted. So question arises that whether in this particular case, whether the automobiles have been declared as wholly exempt. If you see the rate notification, it essentially says that those entries have been substituted with a nil rate. Why this has happened? Because cess act is very typically structured. The cess act says that there is a levy on the goods which are indicated in the schedule. The schedule covers automobiles, and therefore it was not possible for the government to exempt it for the reason that the act of the parliament creates a levy. So unless the government goes back to the parliament, amends the cess act, only in that situation it would have become exempt. So the government, because of the recommendations of the GST Council, took the other route. Instead of going to the parliament and removing those vehicles from the schedule to the cess act, they made it nil rated by virtue of this notification 1 of 2020. 2 of 2025. So therefore, the question arises that in such situation, whether nil rated supplies can be equated with an wholly exempt supply. My answer is that nil rated supply cannot be equated with an wholly exempt supply. In fact, the exempt supply definition itself distinguishes nil rated supply from the wholly exempt supply. And we have this earlier board circular. This was issued in 1975. Where in a similar context, the board received the advice from the Ministry of Law, where the Ministry of Law said that there is a clear distinction between an exemption and nil rating. And an exemption is not equivalent to nil rating. Nil rating is where under the executive power today, the rate of tax has been declared as nil. Tomorrow, by exercising the executive power, the rate can be increased. As opposed to that, an exempt supply is something which is declared by exercising the power of granting exemption, not the power of prescribing the rate of tax. And therefore, the source of power is distinct. The capacity in which those powers are exercised is distinct. And therefore, the board, rightly based on the advice received from Ministry of Law, said that there is a distinction and exempt supply cannot be said to be nil rated supply. So that again would be relevant here to say that when the vehicles have been declared as nil rated, it is not wholly exempt, and therefore section 18.4 cannot be applied, and therefore it can be said that there is no obligation on those automobile dealers to reverse the credit. So this brings me, friends, to the last aspect of today's session. How do we deal with notices? Now, each notice is unique. See, each individual is unique. Similarly, each notice is unique. There cannot be any copy-paste approach at our end. One has to study the notice entirely, because ultimately, what is a show cause notice? It is an opportunity given to the taxpayer to respond to the allegations framed by the revenue. So one has to study the allegations first. Unless you don't listen to what the other person is saying, in this case revenue, you cannot respond. Otherwise, there will be a completely two-sided communication, where the revenue will say something else on the basis of which they want to recover the credit, and in your reply, you will say something else on the basis of which you feel that the credit is not recoverable. So one has to first look at the notice very minutely. One has to carve out what are the grounds on which the notice is making those allegations, and accordingly, then only one can start framing the replies. In fact, recently I came across I had a conversation rather with a very senior advocate of Supreme Court, where he indicated that any practice, either for while drafting the reply to the notice or in any proceedings, requires that 60% of the time you study the matter, you read the matter, and 40% of the time you think over that matter, because the thinking over that matter is what brings out various facets or dimensions of that matter, which you probably which all of us probably requires the time. So essentially, that is how you have to also approach. 60% time you have to read the notice, 40% time you have to think about that notice. Exactly what is the revenue alleging? What are the facts on which those allegations are framed? What are the evidences that revenue is bringing against you? Whether those evidences are proved, whether those evidences are material to the dispute. Many times revenue produces evidences which are immaterial to the dispute, or immaterial to their contention, or to the ground which they are taking in the show cause notice. So this thinking time will help you to clear in your own mind exactly what are the contentions. Then you look at the law and you interpret the law. Then you apply the law to that particular facts which you have crystallized, basis which the revenue is making the claim. And in the end, that is where you pray for the appropriate reliefs in terms of either vacating the notice or quashing or set asiding the particular notice in question. So these are the key steps. One has to do a case analysis. One has to very thoroughly review the record, identify the issues, identify the possible contentions, have a discussion with the client, because many ITC related disputes will have many facets. In certain cases, you may have an opportunity to file a writ petition. Is it advisable? In all cases, it may not be advisable, because in many cases, it is better to go with the regular remedy rather than short-circuiting the process and inviting the court's order, which may substantially damage the case going forward. So one has to understand where the client sits, where the revenue sits, and accordingly you have to have a clear strategy in mind. Then you have to start identifying the facts, the issues, make the submissions. You have to also focus on the findings of the investigating authorities. What are the errors which are committed by the investigating authorities? You have to deal with the adverse findings. You cannot just make your case. You have to also dislodge the case of the revenue. So you need to also have an answer to their adverse findings, either on facts. The facts may be disproved, not proved, immaterial, not relevant, or the facts may not have any relevance as far as the concerned law is concerned. And that is how you have to prepare your reply. Then to make a persuasive reply, you have to have a structure. Thinking may be unstructured when you are trying to develop your grounds. But once that is developed, once blueprint is ready, then you need a structure in your writing, because the other party, the adjudicating officer, or tomorrow the appellate authorities or the courts are going to look at those replies, and they are going to give a huge weightage to those replies to ultimately decide those disputes. That is why there should be a structure. There should be first structure in the terms of, first you have to indicate the brief background. You have to indicate how you have satisfied the burden of proof under section 155. Then you go to the revenues contention, and then you rebut those contentions. While rebutting those contentions, you also clearly put out the law which is in question, interpret that law, consider the facts which are there, support the facts with the evidence. Merely saying that the purchase is genuine would not make your case unless you demonstrate with evidence that your purchases are genuine. If the dispute revolves around clause D, and that is how then in a structured manner you create the submissions. And of course, brevity is most essential, because end of day, in this day and age, nobody has time to read pages and pages, and therefore one has to have a focus and a synthesis of exactly what is the core of the issue and how do you justify that your claim is right in law. Oral arguments, I think this may not be that much relevant for this session, but anyway, I will just briefly touch upon some aspects of the oral arguments, in the sense to say that one has to always respect the forum, in the sense that one has to, rather than being emotional, one has to argue on facts, argue on law, basis the hard work, or basis the findings that you have derived in your analysis, in your preparation, and you have to always lead with the strongest argument first. You have to also bring out clearly that the revenues case is not tenable, and you have to show that why the revenues case is not tenable, and you have to clearly communicate. You have to always start with the main issue, because the other party, the authority, will not be able to understand what exactly you are trying to convey unless they are conversant with what is the main issue or what is the heart of the dispute. Then you just not have to apply to the appeal to the rules, but you have to also consider the aspect of common sense and justice, as to, because that also has a weightage in terms of resolving those disputes. You have to assume the posture of a respected intellectual equivalent person, not someone who gets too emotional or, in a sense, too diabolic. One has to restrain, and one has to say explicitly to the authority that this is why that particular notice cannot sustain, and why the authority should hold in your favor. I'm not saying that by doing this you will find success. In fact, at the lower stages, unfortunately, the way the department functions, in majority of the cases, the result would be unfavorable. But let me tell you, the hard work that we all do at this stage pays huge dividends when those cases are carried further, because when those cases are carried to judicial forums, they look at what has happened before the lower authorities, and they look at how you took pains to justify your claim, and how those were dealt with by those authorities. And that, in my experience, plays a huge role, a substantially huge role in resolving the disputes at the lower stage. So never underestimate the efforts that you are going to put at this stage. It pays huge dividends for resolving those disputes, and therefore the client should also understand that the kind of hard work and the efforts that you are putting at this stage, at the adjudication stage, is essentially benefiting them and creating huge value, even though temporarily they may feel that the result is not as per their expectation or adverse in nature. So, friends, this is what I wanted to convey. I again thank the WIRC, to my good friend Bishan Bhai, to the chairman of WIRC, to Labdi madam for taking the pains and inviting me to share some of my thoughts. Thank you.
Thank you so much, Abhay sir. You have wonderfully given insights for starting from fundamental rights, substantive rights, procedural rights, what are the differences between the same, and how how the input tax credit right actually is, and how we can respond to the notices. Thank you so much, sir.
Thank you so much.